Here's a sentence that should terrify you. The bank holding your life savings does not have your life savings. Not most of it. Not even close. If every single customer walked in tomorrow and asked for their money back at the same time, the bank would run out of cash in hours. And the wildest part, that's not a bug. That's the entire business model. This is the story of how an industry built on an open secret turned that secret into the most profitable machine in modern capitalism, and nearly burned the world down proving it. Amsterdam, 1609. In a cramped office near the harbour, a merchant named Willem, we'll follow him as our guide through this story, is doing something that feels almost embarrassingly simple. He's holding on to other people's gold. Ship captains, spice traders, wool merchants. Nobody wants to carry a chest of coins across a city crawling with thieves, so they hand it to men like Willem. In return, he gives them a slip of paper, a receipt, a promise. This paper says you owe me 100 guilders, a trader tells him one afternoon, squinting at the ink. Correct, Willem says. And if I never come back for the gold, the trader asks. Willem just smiles. Then I keep it. That smile is the whole story. Because Willem notices something within a few months that will echo for the next 400 years. Not everyone comes back for their gold at the same time. On any given day, maybe 5 people ask for their coins. The other 95 just carry the collegium paper around, trading it like it's money itself. Which means Willem is sitting on a vault full of gold that 95% of the time is doing nothing. And Willem is not a passive man. He starts lending some of that idle gold to other merchants. For a fee, of course. He's not stealing. He tells himself that constantly. He's just being efficient with capital that would otherwise sit there uselessly. The seed is planted. A vault built to protect money quietly becomes a machine that manufactures it. Nobody voted on this. Nobody regulated it. It just worked until the day it didn't. 4 centuries later, that same idea, dressed up in marble lobbies, mobile apps, and men in extremely expensive suits, still runs almost every bank on earth. You are Willem's customer whether you know it or not. Your paycheck sits in a modern version of that same vault, and the same quiet math is happening to it right now. So how exactly does a bank take your deposit and turn it into billions of dollars in profit? Let's open the vault. Picture your bank account like a swimming pool. You look at your balance, let's say $10,000, and you assume that number represents actual cash sitting somewhere with your name on it. It doesn't. Under a system with roots going straight back to Willem's gold, banks are only required to keep a small fraction of deposits on hand. In the United States, for most of modern banking history, that reserve requirement hovered around 10%. In 2020, regulators actually dropped it to 0. 0. Not 10%. 0. So, of your $10,000, the bank might keep a sliver in the vault, or at the central bank, and lend out the rest. To a small business, a mortgage applicant, someone buying a car they can't quite afford. That borrower spends the money. The person they paid deposits it in their bank, and that bank lends out 90% of it again. Deposit, loan. Deposit, loan. Economists call this the money multiplier. Every layer of lending manufactures new spending power that didn't exist an hour earlier. Your original $10,000 can ripple through the economy and effectively become $50,000, $60,000, $90,000 in circulating credit. Wait, you're probably thinking, so banks just create money? Yes, not with a printing press. With a spreadsheet entry. A loan officer types a number into a database, and that number is now real, spendable currency, backed by nothing but the I hear promise it'll be paid back. It's less goldsmith with a vault and more confidence trick that everyone quietly agreed to keep believing. And confidence is the operative word, because the instant enough people stop believing it and try to withdraw their money at once, the whole structure buckles. It's called a bank run, and we'll come back to exactly how ugly that gets. For now, just sit with this. The foundation of modern banking profit isn't storing your money. It's the opposite. It's making sure as little of it as legally possible ever sits still. Fractional reserve lending explains how banks create the supply of money, but it doesn't explain how they get rich. For that, you need to understand the single number that every banker on earth wakes up thinking about: the spread. Here's the gag nobody tells you about your savings account. The bank is technically borrowing money from you. Your deposit is a loan you've made to the bank, which is why it's called a deposit. Liability on their books, not an asset. And what does the bank pay you for that loan? In many savings accounts, something almost comically close to nothing. Fractions of a percent. Meanwhile, that same bank turns around and lends your money out as a mortgage at 4, 5, 7% interest. You loaned them money for practically free. They loaned it back out at a serious markup. That gap, call it 3, 4, 5 percentage points, is called the net interest margin, and it is quite simply the oldest trick in banking. A loan officer named Priya, our composite guide for this chapter, put it to a trainee once with a dry laugh. "You're not in the business of banking," she said. "You're in the business of borrowing at 2% and lending at 6%. Everything else is decoration." Multiply that spread across millions of accounts and trillions of dollars in deposits, and you get an industry that, in good years, prints tens of billions in profit purely on the distance between what it pays and what it charges. And here's the sarcastic part, the part that should make you laugh so you don't cry. Banks spend enormous marketing budgets convincing you that a 0.01% savings rate is a reward for your loyalty. It is not a reward. It is the cost of borrowing your money as cheaply as humanly possible. But the spread alone wasn't going to be enough. Because in the late 20th century, something happened that terrified every bank executive in America. People started keeping less money in checking accounts and more in higher yield alternatives. The free money supply was drying up. Banks needed a new revenue stream, and they found one hiding in plain sight. Inside your wallet, every single time you swiped a piece of plastic. In the 1990s, a wave of banking executives, we'll follow one composite figure, a regional bank president named Doug, realized something that changed the entire industry's math. Customers hate fees, but they rarely switch banks over them. Doug's bank, like hundreds of others, started quietly redesigning something as boring sounding as overdraft processing order. Instead of clearing your smallest transactions first, systems were reprogrammed to clear the largest transactions first. Why does that matter? Because if you have $40 in your account and make 5 small purchases, processing the big one first can trigger 4 separate overdraft fees instead of 1, at $35 a pop. It's not a bug. Doug reportedly told his board, "It's a design decision." One internal memo from that era, later surfaced during litigation, all but admitted the reordering existed purely to maximize fee revenue, not to serve customers. By the mid-2000s, overdraft fees alone were generating over $30 billion a year industry-wide. Add ATM fees, wire fees, monthly maintenance fees, foreign transaction fees, and something called an interchange fee, a small cut banks take every time you swipe a debit or credit card, and you get a second, enormous pillar of bank revenue that has nothing to do with lending at all. Here's the darkly funny bit. Banks describe this to shareholders as fee income diversification. Translated from corporate into English, that means we found a way to make money off you doing absolutely nothing wrong. By 2007, between the spread on loans and the avalanche of fees, American banks were more profitable than at almost any point in their history. Executive bonuses ballooned. Balance sheets looked bulletproof. And that's exactly when the ambition stopped being about steady profit and started becoming something much more dangerous. By the early 2000s, the traditional spread business had a problem. Mortgages were considered safe, boring, and, crucially, capped. There are only so many credit-worthy homebuyers in America, so the industry, led by composite executives we'll call the structuring desk, real trading floors staffed by people exactly like this, all across Wall Street, found a way to make the pool of borrowers effectively infinite. They lowered the bar. Loans went out to people with little income verification, low credit scores, sometimes no proof of employment at all. Internally, some of these were nicknamed with a wink, ninja loans. No income, no job, no assets. Approved anyway. If the market keeps rising, one trader tells a nervous junior analyst in our dramatization, it doesn't matter who we lend to. The house is always worth more next year. The analyst asks the obvious question. And if it isn't? The trader just shrugs. Then that's somebody else's problem by then. That shrug was the entire strategy. Banks bundled thousands of these risky mortgages into complex securities, got them stamped with artificially high safety ratings, and sold them to pension funds and investors worldwide, collecting fat fees at every single step of the chain. Not one mortgage, not one borrower. An entire global financial system, quietly stacked on loans issued to people who statistically could not repay them. By 2006, subprime mortgage originations alone topped $600 billion in a single year. Bank stock prices soared. Executive bonuses hit record highs. Confidence, that same fragile ingredient that let Willem's paper slip past as gold 400 years earlier, was at an all-time peak. Nobody was checking whether the vault was actually full. Everybody just assumed it was, because it always had been. And then, in one of the great ironies of financial history, the very people paid the most to notice the danger were the last ones to say a word. 2007, home prices, for the first time in living memory, stop rising. Then they start falling. Borrowers who could only make payments if home values kept climbing suddenly can't refinance. Missed payments spike. Foreclosures spike harder. The securities built on those mortgages, the ones stamped safe, start collapsing in value. Fast. March 2008. Bear Stearns, one of Wall Street's oldest investment banks, effectively runs out of cash in days and is sold for a fraction of its former worth. September 2008. Lehman Brothers, 158 years old, larger than Bear Stearns, considered untouchable, files for bankruptcy. Largest in U.S. history. No bailout. No rescue. Just gone. Panic doesn't stay contained. It never does. Banks stop trusting other banks. Nobody knows who's holding worthless paper. Lending, the entire engine we just spent 10 minutes explaining, seizes up almost overnight. Credit freezes. Businesses can't get loans to make payroll. The stock market loses more than half its value in 18 months. 9 million Americans lose their jobs. And remember Willem's smile, back in 1609, the quiet confidence that not everyone comes for their gold at once. In 2008, for one terrifying stretch, people genuinely wondered if that assumption had finally broken. Governments across the world had to step in with trillions of dollars in bailouts and guarantees just to stop the entire banking system from cascading into total collapse. Not because the banks ran out of clever ideas, because the machine only works as long as everyone keeps believing the vault is fuller than it is. It wasn't. It never had been. That was always the business model. Here's where the story gets uncomfortable, because nothing really changed. Reserve requirements are lower today than they were before 2008. Overdraft fees still generate tens of billions a year. Interchange fees are higher than ever. The spread between what banks pay you and what they charge borrowers hasn't disappeared. It's just been repackaged with a friendlier app and a rewards program. Banks didn't stop taking risks with money that isn't fully theirs. They just got better at making that risk invisible to the people whose money it actually is. So maybe the real question isn't, how do banks make money? Maybe it's this. If an entire global economy runs on the quiet agreement that not everyone asks for their money back at once, what exactly are we all still betting will never happen? Willem's smile, 400 years later, is still sitting in your wallet. If this kind of story, the ones hiding in plain sight inside industries we use every single day, is your thing, there's a lot more of it on Valence. Tell us in the comments which business you want pulled apart next. We're listening.